Welcome to Season 4 of the Knack for Business podcast.
Quick word from today's sponsor. You know that moment when something complicated finally clicks? That's what Fred Crouch does with real estate. His podcast, Property Wizard, from Gentry Learning, makes property wealth feel less like a mystery and more like a plan. Links in the show notes.
Question of the audience. How do you protect your retirement from market chaos and finally grow your money without taking on more risk? And that's exactly what our guest will break down in this episode. How everyday people can use the same hidden low-risk strategies wealthy investors rely on, including life settlements and alternative investments that turn old insurance into real retirement income. Our guest today is Ben Mohr from Life Advisor Solution. And tell you a story about him. He's a trusted expert in retirement income planning, known for his leadership in alternative investments and life settlements. Founder and CEO of Ben Mohr LLC, he guides clients through complex financial decisions and helps them unlock hidden value in unwanted or unneeded life insurance policies. He's also the creator of Life Advisor Solution, a mentorship and business growth platform that equips financial advisors with modern tools, marketing strategies, and industry insights. Along his work with the RMO insurance and retirement team, Ben is dedicated to helping people approaching retirement, making confident, well-informed choices with clarity and peace of mind. Ben, absolute pleasure having you here. Welcome. And do you have a favorite quote or saying, sir?
I was just looking at that. Yeah, I would say the one that I probably tell people all the time has really not much to do with business, just a life advice is this too shall pass, right? I see people talking about that all the time, and I believe in it. It's such a simple thing. But if you look at it on both sides, it's what it means is this too shall pass. And people think of like, oh, you're having a bad time, just wait it through. But you also have to look at it when life is at the very top. This too shall pass as well, right? Right? I think we learned that in life, right? It's like when it's really good, you better realize that it's really good and enjoy the ride until it's over, and then you're going to be back at the bottom. And again, remind yourself of the good times, because sure enough, it's just right. It's a high wire act life, right? Ups and downs, and enjoy the peaks and realize that there's a reason you're at the bottom for whatever reason. Find something to learn from that, and so the next time you're down there, you go, oh, I've been here before. So that's kind of been my motto to everybody I talk to, is when they have their problems or when they think they're high on life, it's like, either way, it's fleeting. So enjoy the ride.
Kind of exciting thing in the financial planning business. Due to a combination of good planning and stewardship, I can live comfortably the rest of my life with my current finances, which is exciting.
Yes.
Providing I die by 6 p.m.
Yeah, I mean, it's true. I mean, yes, I agree with that theory too. I mean, you can only do, when people talk planning, right? Planning is only so much, right? It's planning for just the everyday mundane, but there are things that happen, right? I mean, there are people who probably do everything right, Rain? They do everything right. And then, I don't want to be gruesome, but could get hit by a bus walking across the street. And then it's all for naught for their lives. But I mean, for their families, at least they left something, but they're gone. And then there's other people who've never planned, who then realize they might live to 100 years old and kind of got to figure it out, right? So yes, planning is planning, right? It's not a guarantee, right? And nothing out there. I mean, these people in my industry can tell you that if you do this 100%, blah, 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 that's just not true, because there's always the unforeseen. Correct.
So what brought you into this space? Were you like in grade school going, you know what? I think I'll be a retirement planner. That's the ticket. Yeah.
No, not at all. If I think like a lot of us, right? I mean, I'm sure, Bernie, you were sitting there in third grade going, I'm going to do a podcast, because they didn't exist. If you did, you should be on an island somewhere, because you came up with an idea no one could ever foresee, right? No, not at all. I'll give you the quick 20 seconds. Like any child, I was a pretty good baseball player growing up, went to college on a scholarship, etc. So that was the game plan, right? Till about 20, right? That I'm just going to play baseball the rest of my life. Then I actually got into being into broadcasting and wound up being a news reporter around the country for maybe 10, 15 years around there, and was successful at that. And then literally just fell into this business. I always say to people, like, how did you get into this niche or whatever you do? And I always say, I Forrest Gumped it, if you understand from that movie, right? I Forrest Gumped it. And that's life, right? I mean, people are always asking, younger people, I mentor a lot of younger people, and I just tell them, hey, I'm telling you right now, it's really about who you know. And I don't mean like nepotism, but it's like, if you just go out there and put good vibes out there, you'll be shocked. I mean, I sit back and look at the connections I have, guys, with people in life, and 90% of it was I met them somewhere, somehow, randomly, and was a person that they liked. And, and then you realize, whoa, here's an opportunity. I'm not going into meeting people with the manipulation of I'm going to put on this face and salesy. It's just, I can't tell you, every single day I meet somebody and then I'm like, that's an opportunity for us to possibly work together, right? And 90% of the time it never pans out, but that 10% is a lot. I mean, the major relationships I have in my life are pretty much completely random, right? That I look at today and go, here are the 10 people I work with all the time. And if I think about how did I meet them, it wasn't because of my education. It wasn't because I read some book or went to some networking meeting. It was relationships met. It's kind of like a natural, organic LinkedIn, right? Just I met somebody who knew somebody, and then I found somebody and I'm like, whoa, this is a relationship I'm going to have for the next 10, 20 years because both of us see eye to eye on how we see business, right?
I just had this mental image of an organic LinkedIn. It sounds like a bad horror film, worse than AI. One thing, I'm interested in language. Language changes. The language of yours is life settlements. I've never
Yes.
heard it structured that way, and alternatives. So unpack what that means in
Yes.
your vernacular.
Sure. So when you hear alternatives, it's just a euphemism for saying that we help people invest in things outside of what is considered the average norm. And what the average norm is this in America is, almost most people who work have retirement plans within their companies that they work for. And where are those retirement plans? Where does that money go? And it almost always goes into the stock market. So the stock market is the norm. So we don't work in the stock market. The other thing, and so anything outside of the stock market is considered an alternative to the normal, Wall Street. So first off is alternatives are additional ways that most people go, oh, I didn't even know I could invest that way. Number two is life settlements. Now, life settlements as a whole has two sides of the street. One side of the street, which we do not work on, which a lot of people think is a life settlement, which it is, but it's the other side. Think of it like buying or selling a house. If somebody has a life insurance policy that is a permanent policy, they can sell off their policy when they get older because they want to take money now and use it for end of life care or whatever. So an example for your listeners at home, give you a real simple example. John Smith, he's 80 years old. He's got $1 million life insurance policy, but it's not worth anything unless he passes away. Right? Protection for his family. Now, maybe he bought it when he was 50 because he had a mortgage and he has kids. And if he gets, again, gets hit by a bus, something like that, his family gets $1 million and they're taken care of. Well, now let's look at him when he's 80. When he's 80 years old, why does John Smith need the $1 million? The other thing is he's still paying the premiums, the annual cost every year to keep that thing going, which might be $20,000, $30,000, $40,000 a year. It's expensive at that point. So he instead can just dump it to somebody like me. Maybe we pay him $300K. He now has the $300K for end of life care, and now we own the policy. Now, that is the side of the street I do not work. Where I work is we get those policies, and then investors come in and buy those policies from us, right? So, for instance, like right now, I've got a policy where it's on an 84-year-old male. Life expectancy, I think, is about 4 years. And if somebody came in and we could sell it to somebody right now for $60,000, and when that guy passes away, they get $150,000. That's how it works, right?
Does it also go by a name like viaticals or something?
Very good, Wayne. Yeah. So when we say life settlement, it's generic. It's like saying a vehicle, right? When you get into viaticals, it's more like saying I'm going to buy a Honda. It's a viatical is a specific area of life settlements, and so a viatical by uh, by definition is somebody who has a life-threatening illness who's expected to pass away in 2 years or less. So we're not really in the viatical space. We are in a more generic space of when you talk about a viatical, you're going to be like, oh my God, this person has some kind of cancer and they're going to sell their policy. We don't really work that area. We're more expansive where we're just dealing with people who, I hate to use the term, but are elderly, so to speak, 75 years or older, who don't have a specific, if I showed you one of our medical reports, you're not going to go, oh my God, it's a amalgamation of many medical issues that you go, this person is less than healthy for someone in their age group, right? Where viaticals all became the rage, Wayne, was, and that's where a lot of people heard about it, is when the AIDS epidemic hit in the early 80s, there was a lot of young males in America, so to speak, who were selling off their policies because they needed money to pay for things like AZT or whatever it was. The problem with a viatical, the risk there is usually you're getting a person who is younger, right? Meaning that they've now have some medical issue that hit them, that it could be cancer, it could be something like AIDS, it could be whatever. The problem with that from an investment perspective, and I don't mean to be ghoulish, is with medical advancements, things can change. And I think the AIDS epidemic shows you that exactly, that we now know that with HIV, it is not, in 1985, if you had HIV, it was a death sentence, right? There was nothing you could do, and you're lucky if you lived 3 to 5 years. Now we see on commercials all the time with like medicine like Victory, where if you were diagnosed with HIV today, you can be taking medical medicines that would make you undetectable, and you're going to live almost a normal lifestyle, if you will, and could live to your age expectancy. So that would be a bad investment, right, so to speak, because now you own somebody's life insurance policy who might be 40 and that person could easily live to 80, So we're dealing more with people who are already advanced in age, right? So just naturally, they're not expected to, the average life expectancy, I'm going to guess for Canada, and it's much like in America, for a male is probably 80, 81. So as I just mentioned, we've got an 84-year-old. He's already lived beyond what is expected. He's just on borrowed time. And he has also medical issues. So long story longer, that is what a life settlement is. A viatical is part of that, but there is some risk there because, yes, while they might have a life expectancy of less than 2 years, something can come around with medical advancements that turns that life expectancy into 10 years, right?
And just as because I have some understanding of the industry,
Yes.
did you start with a large insurance company where they gave you a binder and a phone book and said, go do it? Where to cut cut your teeth, or how did that journey start?
Absolutely not. I did not come in from that angle, which I think helps me in some levels because you kind of get trained on what that group does, whether it's a New York Life or a Transit, whoever it is like they have their way of doing it. Absolutely not. How I started in this was I decided I want to get out of the TV industry, kind of searched around, fell into a group that was doing annuities, which is an insurance product. I didn't work for an insurance company. I was what's known as an independent agent, and where I cut my teeth and became very good at what I did because I had that broadcasting background, so I can present, right? That's essentially that's what a reporter does, right? It explains in 2 to 5 minutes something that went on in the day into a very easy to understand situation. So all I did is transform that into dinner seminars and did my own thing. And so for a long time, I was selling insurance products like annuities on my own independently, and then fell into this investment in my journey, tried it out, put it into my seminar, and it took off like wildfire. All of a sudden, because here's the thing, Wayne, is people come to dinner seminars, and I ask this all the time when I do it. I'm like, how many of you have been to a dinner seminar? Almost all raise their hand. How many of you have been pitched annuities? They all groan and go, oh, yeah, okay. So I joke and say, guess what? The good news tonight, whether or not you do any business with me, is we're not doing that. And they all kind of clap. So yes, I kind of was like, everyone's zigging zag, right? So my angle is, the reason I think I came into this was I like what I do, but also I have a message that no matter if they're interested or not, it's something that they will admit they've never talked about. And that's always a great thing to have, right? Is that if you have a product that you're at least going to get people's attention, right? And go, I've had people come to dinner center where I say, it's not for me, great, but they go, really interesting, right? And that's at least that to me is the catch, is that I can sit with anybody anywhere and they're like, what do you do? And I explain it. It's not the basic, well, I sell life insurance, retirement planning for life insurance, blah, blah. I'm like every other guy down the street. I mean, I could probably throw a rock from here and find 5 guys on my block who sell annuities and IULs and all that. So then I'm just like everybody else, right? So with my thing, I'm never having competition of anybody who are like, oh yeah, I met a guy yesterday who does what you do. That's not possible. There's not a lot of us out there.
Well, there's not a lot of you out there, so couple questions come to mind. How do you find somebody? How do you know that? Yeah, that's the real McCoy, and and who's looking? Is it grandpa, grandma, or is it the offspring? What?
Oh, you mean for people who are selling their policies?
Yeah.
Yeah, it's definitely a buyer's market because there's just so many life insurance policies out there. So that side of the street, I have a partner who does all of that. But what they do is they don't really have to prospect. There's a lot of, I mean, you see commercials on TV here all the time for companies like Coventry that sell your policy now kind of stuff. They're all out there. Betty White, who passed away maybe a year or two ago, was the national spokesman for life settlements. So there was commercials with her. They're all over the place. So the way that they usually sell, Bernie, is your life insurance salesman on that side, the guy that you bought it from, you'll probably come to him, or your CFP, your CPA, maybe your trust attorney. They know this is an option for you. And so you'll sit down at 80 and go, maybe I need long-term care. I need somebody to help out. Well, I don't want to sell the house. I don't want to reverse mortgage the house. I don't want to dip into my retirement accounts because that's a tax bomb. What can I do? And they're looking at this thing and they're like, well, how bad do you need this? I don't need it. Well, you could get money for it. So we are approached, and there's a database that we're signed into. Think of it like here in America, we call it the MLS. If you guys don't have that, there is, that's like real estate, right? So we plug into a database. And what it does is it just tells us, what the framework we're looking for, right? So it'd be like, hey, we're looking for, Wayne talked about viaticals. There's an area where you could probably just be like, I'm looking for 2 years or less LEs, life expectancies, and boom, you're into a viatical space. Our angle is going to be more like, we're looking for 75-year-olds with life expectancies under 8 years, with permanent policies, and whittle it down on that. And then those lawyers, CPAs, et cetera, are placing those policies in that basket, and then we're able to obtain from there and start the conversation, right? But to give you guys an idea, I mean, from what I understand with my partner, he's analyzing policies all the time because insurance policies have a lot of catches, right? I mean, there's a lot of them that can implode, meaning that, yeah, it's permanent policy, but it's only permanent to 95, or the escalating cost later on. So he has to analyze these things to make sure they don't blow up 10 or 15 years from now. And I would say after negotiations and everything's done, maybe 5% of the policies we actually wind up buying. So he's got to go through 100 policies to find 5 that meet our criteria, one, and that the negotiations actually go through. Because once you enter negotiations, they can fall out all the time, right? We do find on that side that their expectations a lot of times are extremely unrealistic on how much money they're going to get. And it's like, no, and it's funny because I talk to people all the time. I just talked to somebody yesterday, and a guy was like 60 years old and he was very healthy. And he's like, well, I've got an old policy and I always say, I'm not buying policies that way, right? Number one, I wouldn't buy a 60-year-old who's healthy. Why would I buy it? It doesn't make sense. So it's got to be the perfect situation, and that's what works. So we don't have a hard time finding policies that people want to sell at all.
In a perfect world, you're on this podcast.
Yes,
I assume our charms are part of the attraction.
absolutely, Wayne.
But what would I mean? Are you trying to inform? Are you trying to find the ideal customer? Are you trying? Why do you want to spread the message you're spreading? What can we do for you?
Sure. The whole thing for us is to educate investors that this is an opportunity, right? And then that's it. Realistically, letting people know that if you're sitting around with money sitting around, could be in a bank, could be in a CD, could be that you're have money, in the market and realize, hey, that's where I am. We find that people are overexposed in the market. So I always talk about what I talk about is true diversification, right? So if somebody's sitting on $1 million, including their IRAs, et cetera, and I'll do analysis and find out that literally their money usually is in one of three places. It's going to be a lot of money in the market. Maybe they've bought some real estate investment, and maybe they even have an insurance policy or an annuity for some type of retirement planning. That's great. Okay. That money winds up in three different buckets. We call it the risk bucket, which is the market. We call the other bucket, your income bucket, which is what you want to have money down the road. That's going to be your annuity. And then they have safe money, which is great. Like money, hey, in case I just need money and sometime soon, that's going to be your CDs. What we say is you need to have an alternative bucket. Maybe 5 to 10% of all of your money should be in a place, because what we offer, Wayne and Bernie, is what we call a non-correlated asset. Right? Is if you sit down with me, like I just explained, hey, somebody can come to me tomorrow with their IRA or with just straight cash, and they can own an 84-year-old guy's policy who it's going to be for $150,000 is what you're going to get. You're going to pay up front $60,000. I say to somebody, I implore you to tell me that whatever happens in the economy in the next couple of years, how does that affect this investment? It doesn't, right? Period. I mean, I don't want to be morbid. The risk you have here is longevity. All you care about in this situation is, when does this guy pass? Right? Which we do all the tracking for you and the servicing. So it's, you just sit back and we get you payments. And we just paid out on a policy $3 million back in October, and the APR on that for the average person who was invested was 20% compounded. That's twice as much as what the market will do in an average year. So that was double the returns, and that's 5 to 6 times the amount you're going to get in a safe product. I can't guarantee those results, but we have plenty of examples of that. So that's what we're trying to let people know is, don't think that just the vanilla way of doing things that your advisor tells you this is how it is, that they're diversifying you by spreading your money around the market. The analogy I give there is hey, why don't we go to Vegas and I'll have you play on the craps table for 15 minutes and I'll pull you off and put you on the roulette table for 15 minutes and we'll play some Keno while we have lunch. And then when you're down $500, you go, well, wait a sec. I go, well, Wayne, Bernie, we were diversified, were we not? Right? We're still in Vegas, right? So that's kind of our angle, is why not take a portion of your money where you can own something that is, by the way, paid from some of the strongest companies in the world, right? You understand that there is a timeline on these people. They're not going to live forever. And there is a payment at the end of that rainbow. And it has nothing to do with the economy, politics, interest rates that are going on, foreign wars, Ukraine, COVID, nothing like that. That's what we stand on. And by the way, this is exactly what Warren Buffett does. He has bought over $1 billion of life settlements himself, and what all the large financial institutions do. But they just do it behind closed doors because they don't want to sit there and say, yeah, the market had a bad year, but we did great because X amount of people died this year. I mean, they're never going to say that. They're never going to say that.
That doesn't sound like a marketing pitch whatsoever. Grim Reaper here. Thank you.
Yeah.
So when you're setting this up, and there's a lot of process here, what are the regulations that are wrapped around it? Is it based on local? Is it based on federal? Is this just in the US of A? Do you see this happening in other countries like Canada?
Yeah, so that's a great question. So when it comes down to regulation, it just depends on how the offer exists. So there's two ways you can go about it. If you buy into essentially what I would call a portfolio or a fund, which is one of the companies I work with does that. So if you do that, for instance, instance, let's say in California, there's a company I work with. If you buy into their fund, it's going to be regulated by the state of California. Now, the federal government can come in as well and pick at it as well. They have the right to do that, but mainly California would do that. And so California has its restrictions there on how it can be bought. So in the California offering, you have to be a California resident. You have to have a certain amount of net worth, $250,000. And then there is a limitation on how much you can buy because obviously this is not a liquid product, right? So if I'm sitting in front of somebody and they've got $1 million and they go, love it, I want to put $500,000 in, number one, that would be irresponsible. So it's more like they could invest about 100 grand. If you go outside of the state of California and again into a fund, you are dealing with federal laws, right? And it's what's known as a PPM, a private placement memorandum. You have to be an accredited investor. You have to show that you're an accredited investor. For your people at home, that means they'd have to show they're worth more than $1 million. And then there's restrictions on how much they can put in. Now, if you buy whole policies through us, there isn't really anything there because you're not investing with us. We're just the broker, right? So it's like real estate in that sense, is that I can sell to anyone, anywhere, anytime. Obviously, we're going to do our own suitability to make sure that you're suitable to buy it. Right. But what we're doing there is brokering. It's literally, I've got a person over here who wants to sell this policy I brought up before. This guy, it's $150,000 death benefit. You're going to buy the whole policy yourself for 60 grand. We're just the brokers in the middle. So there really isn't any regulation there. And on any of these, by the way, yes, around the world, anybody can come and invest with us. Obviously, we're America based. So we deal with a lot of US clients, but we do have clients. We've had clients in Canada. We've had clients in China. We've had clients in Japan, Mexico, etc. It just depends on, to be honest, it's fluctuating, is that when we bring in the funds into our bank and the trust and all those things, the bank has regulations on certain countries we cannot do business with, and that fluctuates day by day, right? It makes sense. Like, obviously, if it's a country where if people want to get into it, it has to do with, anti-money laundering training kind of situation, which is they don't want to deal with certain countries where they know it could be like drug money or a terrorist kind of situation. I know it sounds kind of weird, but so every once in a while, certain countries are on the list. I'll explain this. We do business with people in Mexico, but obviously that is a situation where the bank takes a while to look at it because they have to get the person's passport, look at it, and make sure they're not on like the narco, list. They literally do. So I don't want to be silly, but if I get a guy named, Juan Sanchez from Mexico, we know when we get that passport, it's going to be about a 2-3 week process because there's probably somebody within the cartels named Juan Sanchez. They have to go through, look at the passport, make sure it isn't that Juan Sanchez, and then come back and say, okay, he's all right to invest, right? It's a process, but we already know that's in Canada. You can't go people up there, or you've got people around the world. Canada, England, these first world countries, not going to be a problem, right? That we don't have to go through that kind of vetting.
So, Ben, I love finance and I love unlocking things with a different mindset. Now, most people know that good old vanilla whole life was paid. So you got a cheap rate when you were 21, when you bought the policy, because that's when your insurance agent told you to buy it.
Yes.
And you overpaid for it. And then that money, part of that went into a fund that they loaned out, the insurance company loaned out, that was their income that gave everything liquidity. And then the idea was there was a school that says, okay, you can go in this policy for 30 years and you've had some value, some cash value that because you didn't die, and that you can actually take that cash value out. This is the next step. Can you explain the difference when, rather than just taking your $1 million policy and getting your own cash because you overpaid for it,
Yeah.
rather than this process?
Sure. So let's break it down very simply when you look at, and I know I'm being very generic if there's insurance people out there, I go, this is not how this works. Well, for the people at home, please bear with me. This is just basics. There's essentially three subsets of insurance you can get. There's term, right? Which is, well, I equate this again to real estate so people understand that's like renting insurance, right? So you're going to have a term 10, 20, 30 years. And then after that time, you're not going to have the insurance anymore because that's super cheap in cost. I'll give you an example. I'm 52 years old. I bought a policy probably when I was 35. I bought term, and I think I pay literally $600 a year for $1.5 million in coverage. Now, I'm hoping I live the 20 years. And what does that mean? It means after 20 years, I paid $12,000 to an insurance carrier and I lost on the money, but hey, I'm still alive. So happy to pay it, right? But that ensured that while my kids were small and all that, that if I did get killed unexpectedly somehow, it would be protection, which is what people should buy insurance for. The other vast other side, Wayne, that you were talking about is whole life, where you are what's called overfunding a policy, right? So what happens is there's what's called COI, cost of insurance. They're going to take out the money where you're paying for the insurance, but now you're going to have a lot of money left over. In whole life, they're giving you a guaranteed interest rate on that money, right? Is what you're talking about. So now all this surplus money has been put into a cash accumulation account, right? And that money is making the interest. In theory, what happens, as you'd said, is after 20, 30 years, you're going to have so much money built in there that you no longer have to pay the premium, the cost, because the interest generated on that money pays for the insurance policy. What I would equate that to is like being on a 15-year mortgage, right? You're accelerating the mortgage, paying off the cost, and now you can sit there, if you bought a policy when you were 30, at 50 years old, you're not paying for it anymore. And there's also cash value that you could borrow from, as people know. And if you borrow from a life insurance policy, it is tax-free, right? That is the idea. So that is that way. In the middle is what's known as universal life insurance. Okay. And universal life insurance, normally the way the old school, there's a lot of new bells and whistles, IULs, blah, blah, blah. And I'm not going to get into that. But the old way of universal life was it's kind of like having a 30-year mortgage interest only. What I mean by is you're just paying for the cost of insurance. The cost of insurance is much higher than on term, because you're going to have a permanent policy. So they know you want to have it. So you're going to pay more every single year to keep this thing going, though you never put money in. You're not overfunding, and you never put money in that bank that accrues much interest. You just want to know that you have your rate locked in when you're 30. Yes, it escalates over time, but it won't escalate for about 30 years, and you're going to keep this thing until you die. Okay. So now that I've explained those three different angles, we only work in the universal life sector, right? Because number one, we're not going to buy term policies because that doesn't make any sense. Wayne, I come to you and go, hey, I got an 84-year-old guy, as I mentioned, but it's a 30-year term and we're in year 28. You're like, well, what happened? No, that's bad. The other thing is that guy would never sell his whole life policy ever because he doesn't have the expense. It doesn't cost him anything to keep it, right? What we're dealing with is universal life people who bought a policy years ago and now they're waking up and going, yeah, I bought it for permanent, but now I'm in a position in life where I realize I don't need the coverage anymore. Kids are older, they're established, they've got their families and their houses and blah, blah, blah. Everyone's covered. Why I bought this thing where I thought I needed the coverage, that coverage doesn't really exist anymore. And now I'm paying money into this thing every year and I don't really see the need for it anymore. I don't really want it. Yeah, I could give my kids $1 million and great, but they're all doing well. That's just kind of cherry on top stuff. What I'd rather do is get my money now and pay for my end of life care. So the way we explain to people is whole life is about this. It's what you're looking for is max accumulation in a policy. You're trying to put as much money into a policy to accumulate to make money so you don't have to pay premiums and there will be money you could use. And it's very expensive. What we're about is these people bought universal life because they're looking for the minimum amount they have to pay every single year for maximum death benefit. Okay. And now they're in a position in life where they don't, tax laws have changed in America over the last 20 years about what's called the estate death tax, if people aren't familiar. There used to be, it still exists, but if you died and you had a certain amount of net worth, you not only had paid taxes and income, but you also got taxed on death. And people think it's a double taxation, and it is. Well, they changed all of that probably 20 years ago to where the people who get nailed by that, it's such a small segment. I think now it's over 20 million. You know, when I got in this industry, it was like $2-3 million. If you had more than $2-3 million, you were going to get hit with the state death tax. So people bought these insurance policies to pay the state death tax. Okay. Now you wake up today and I think it's over $20 million. So the subset of people where that affects them is really, really small. So a lot of these people, Wayne, as you were talking about, 20 years ago, there was a large group of people who needed to pay that tax. Now that doesn't exist. Well, they bought these policies 20 years ago. Now they're waking up and going, why am I paying on this thing? I'm not going to have that tax problem. Right. That's where we're seeing a lot of this.
So if someone comes along, they're the investor.
Yeah.
And they want to buy. Do they just roll up and come up to the office and go, Ben, my man, talk to me? Or is it you need a lawyer and accountant kind of in tow? Like what? Because it's like if you're investing in real estate, right? There's
Yes.
a whole bunch of entities that'll be around you to give you expertise from different angles, right?
Yes. Yeah. So our angle here is we make it real simple because unlike real estate, most people are already familiar in real estate of that you're probably going to have a realtor and then there's going to be an escrow company and et cetera, et cetera, et cetera. So you're already kind of familiar with what that is. We're all one-stop shop. We handle all of that for you. So whether you're using retirement money or you're just using straight cash, we do all of that. So what's involved? Well, number one is we're going to place the money for you. We're going to put it in the system. Let's say if you had an IRA, we're going to open up what's known as self-directed IRA because you can't use your Schwab account or any of that because those companies, Fidelity, they're only market-based, right? So for instance, as somebody, I'm doing one deal right now where if they want to take $50,000 of their money that was in a Schwab account or a Vanguard account, we open up a self-directed IRA, which is these are companies that allow you to invest in alternatives. So that gets set up, money's placed there. We do all of that work. You just DocuSign, right? Because it's confusing. We set it all up. We do all of that. Okay, so that's how that works. The second angle is if you did cash, we're going to help you walk you through the process. And then after you invest, what's left? Just what we call servicing. And we have a servicing company that we've hired that has extensive background in this business. And what is servicing? Well, think about it. While the person is alive, there really is only two things that are going to happen. Number one is premiums need to be paid. And depending on how you buy this, we might have already had premiums set up for you for a period of time, right? For somebody's life expectancy, so to speak, you may not have any premiums. That depends on which policy you want to buy and how. So we have a servicing company that makes sure they make the premium payments for you every single month so the policy doesn't lapse. Okay. And then number two, they're doing health tracking on these people to see when they pass away. Right? Once they pass away, they go get the death certificate, they deal with the insurance carrier, get the money, and then they distribute the payment to you. So all of that, if you were in some other business, or by the way, a different company than mine, you might have to go get different entities to do this, and you don't even know what to ask. We've made it very simple when we started our business a long time ago because we saw how that was. We have it all. I quarterback it all for you. You don't have to worry, when it comes even to how, your taxes are done, any of that, we handle all of that. So yes, they can literally roll up, or if they go to us, once you come to me, we handle all of it A to Z. There's nothing they have to do, right? We handle all of it.
Have you ever had something go quirky though? Someone buys the policy, et cetera. Person goes missing. You don't have a body. Boy, kind of a worst case scenario. Have you ever had a magic moment going, that's the unicorn going in the wrong way?
We've never, obviously you sit down and you can dissect it and go, here's how things can go wrong. Is that a possibility? It's a possibility. I've been in this business 20 years. I've never seen it happen. Number one, remember, we're doing tracking on people quite often. Okay. And I can walk out how that happens. So them to go missing would be kind of odd. And I'll write that down. Is it a possibility? Sure, it's a possibility. It's not a probability. I've never heard of that happening in the industry. It doesn't mean it probably hasn't happened somewhere, but I work with myself and people who've been in this industry a long time. I've never heard of that happening. But is it a possibility? So no, you got to look at where this is. You're dealing with some 80-year-old, probably fairly immobile. Right. These aren't people that are going around and visiting, the jungles of the Amazon, and then they're not going to some remote area. But the issue is what we do is that we track them through themselves. There's calls that go in, and then we also, if we don't get in touch with them, we're able to get in touch with family members, things of that nature. So it would be very weird. I'm not even familiar in a case that we have where we've ever called anybody and they've said, oh yeah, well, mom isn't around to answer this call because she's in Zambia or whatever on some safari at 83 years old. Right. So obviously, theoretically, it's possible. And it's funny, Bernie, I get these questions. That's not even the craziest question. The craziest question I've ever had, this was hilarious.
Alien abduction?
What? No, even crazier. No. And here's what happens when I do dinner seminars. There's always, I consider it like doing. I'm performing, right? And so I'm in front of 50 people, and yes, and what you have to do is you have to keep your calm and demeanor. And I'm not a guy who's like sales pitchy, right? I'm just there, like I'm talking to you guys, just explaining. Right. And I always know there's going to be one person. It's almost always a guy. Right. And what they want to do is they want to show everyone that you're BS, you're an idiot, and he's smarter than you, and he's going to poke a hole. And I had a guy at a dinner one time say, well, I have a question. I said, yes, in front of 50 people. He goes, well, what happens if a person gets their head cryogenically frozen and then 100 years from now gets it put on a cyborg body? They could come back and then sue the insurance carrier saying they aren't actually technically dead. And then you and your company and your investors are going to get screwed over. Now,
who's going to be around for that?
Well, yes, but what I realized is this guy's a schmuck, right? And I'm hoping that everyone else in the room realizes how ridiculous this question is. But rather than berating him, I realized there's 49 other people in this room and they want to see how I react to adversity. Am I going to get red-faced? Am I going to get argumentative with just an asinine question? Instead, I just kind of sat back and I said, well, sir, there you found it. You found our weak point here. We don't have any kind of mitigation risk for cryogenically frozen heads on cyborg bodies 100 years from now. So I said, everyone in the room, if that's a concern, if you're seriously concerned about cyborg bodies with cryogenically frozen heads, enjoy your chicken dinner. Do not sign up and talk to me because I honestly don't have an answer for that. And everyone kind of chuckled, right? And I said to him, obviously, sir, this isn't for you. Enjoy your dinner. Have a great evening. There's no reason to sign up. Don't even turn in your form because we're obviously not going to see eye to eye or frozen head to frozen head. I mean, whatever you want to call it.
Wow. That's very obtuse. The only reason I was asking the question is that if someone decides to go on a road trip, they off the face of the earth, and you need a death certificate. If you don't get the death certificate, everything
screwed.
stops.
Yes. Yeah. Well, in America, usually it's a certain timeline where I think the longest term would be if somebody has gone for 5 years, then they can be declared dead. My guess is if somebody was 82 years old and went missing, we have good lawyers. We probably could exceed that process. By the way, the family would probably help us as well because there's a lot. Think about this, not just us, right? It's their life insurance policies wasn't the only thing. If they have a trust and they have like a house and all this stuff, that family is going to want to get this thing going as well, right? So they would be in conjunction with us of like, they're not just going like, well, screw you guys. You have the life insurance policy. What do we care? They probably have a ton of assets they want to get all entangled as well. So we could join with the family and they're going to rapidly they're the ones who are going to be able to figure out what the heck happened to grandma, right? So there's, we have places in force for that. We have really good attorneys on that to help out. I mean, we just had one right now. I don't want to be too morbid where we had a policy where the person passed away, like I think it was supposed to be like an 8-year policy. They died in 3. So the APR for the clients was ridiculous. And so I was kind of like, interesting, because usually, guys, you can look at ones and go, this one probably is going to hit pretty quickly, right? And this was one where it was off the grid. It was a woman. She was mid-70s. We weren't expecting her to die in several years. And I get the call. She passed away. And I'm like, what the hell happened? Well, guess what? She got hit in a Target parking lot by a car. Right. So what happens there is you think, okay, well, now that we move on. Well, she's passed away. It's clear how she died. Let's go get this. Well, it gummed up the works for a couple of months because of the fact of the way she died. While you and I just look at it and go, car accident, but the wouldn't hit the investigation went on, right? Because how do they know just because you got hit by a car doesn't mean it's an accident, right? Now it would pay out. It's Bernie, it's going to pay out. Even if somebody intentionally ran her over, the problem is the investigators hadn't finished their report. So on the death certificate, it said like under review or something like that. And until that happens, the insurance carrier isn't, even if it was homicide, that's fine. They'll give it to us. But on the death certificate, it has to say exact manner of death. So that's, those are the little wrinkles that you can have sometimes that you need an official cause, right? And so even though you go, well, she got hit by a car. Yeah, she did. But how do we know that that isn't homicide?
Circumstance.
How do we know she didn't jump out in front of the car? And yes, by the way, policies do pay off for suicide. That is something people always go, I've heard that no. So what happens is there's a thing called 2-year contestability, meaning from the time that an insured bought the policy, when Don Smith bought the policy when he was 50, if he kills himself in the first 2 years, it will not pay out. After that, all bets are off. You're buying policies from people who are 75, 80 years old. They've had these policies for 15, 20 years. So yes, if John Smith at 80 decided life was no worth living anymore and goes and takes a bunch of pills and decides to end his life, it will pay off because he didn't buy the policy intentionally to profit off his death in the first 2 years, right? This is 25 years later. So those policies do pay.
I'm not specific. Did the woman not realize she was a target?
That was a bad pun.
She was a
That was
target.
a
She was a
bad
target. She was a target at Target. Is that what you're saying, Wayne? Hopefully, it was in front of the bullseye. That would be really ironic. I love the humor, and I'm sure some people at home are kind of going, "You guys are a little sick." The issue of yes and no. You got to have some humor with this because some people are just like, "I'm just a hilarious one here," and I kind of point out is the big one I always have is like, "Oh, I don't think I could buy this because oh my God, it seems weird to profit off somebody's death." And it's, by the way, that is always, and I said, it's always a man who gives me a hard time at the dinners. It's always a wife that has that, like, mercy me, right? The husband just wants to know returns, by the way. Right? He's not asking. He's good with it, right? And it's hilarious because I have the same conversation. I say, ma'am, so you don't want to profit off of a policy that somebody doesn't want anymore. You're giving them money for end-of-life care, which is a nice thing. It's a win-win. They don't want it. You don't know them. You don't care about this person. They are going to die just like the rest of us. But here's what I say. I go, do you have life insurance on your husband? And she's like, oh, of course. I go, so yeah. I'm not understanding. You have absolutely no problem on getting a paycheck on the man that you've been with for 40 years and the love of your life and the father of your children. You're just like, you can't wait to submit that death claim. But on somebody you don't even know, you have a problem? Either you're against life insurance or you're for it. Well, I don't get the deal, right? And that's my argument there. It's kind of like, these people, by the way, if you don't buy the policies, their other angle there, and you understand this because Wayne, you brought it up, is they're going to have to surrender the policy to the insurance carrier. And there was a Wharton School of Business study that found when people go on the open market and deal with us or people like us, they're going to get 4 times the amount that they would get from the insurance carrier, right? Yep. Why wouldn't you do that, right?
If you the light bulb came on and you said, you know what? I'm maybe a little overinvested in the stock market and the house is paid for and I'm bored. How would we get a hold of you? How would we start a process?
Right. So I think in your guys' notes there, there's this, the people can reach me easily at, it's Life Advisor Solution, no plural, advisorsolution.com. And I can be reached at ben@lifeadvisorsolution.com. I'm very easy to get a hold of there. There's Calendly links. There's what we call like a link tree, if you will. It has all my information. If they want to see the actual process, what it is that we have a website that has actual policies on it. I'll give you this one, and then it's called lifepolicymarket.com. Is if you can there's like 6 policies on there, they can pick and choose, they can put their information in there. And then, but the easiest way that I would like to do is to start with people like to come and have a conversation with me so I can understand, it's not a long conversation, just what they're looking for. If they go on there, they're going to have plenty of information. Equilife LLC is another one. That's the California company, but we have nationwide as well. But Equilife is EQUILIFE LLC.com. I have ebooks, videos, just tons of stuff. You know, I have I have a YouTube channel. It's called Truly Diversified with Ben Mohr. You're going to find, 100 videos on there on different subjects, whether it's like, hey, how do you invest with an IRA? How is this taxed? How do you guys do life expectancy reports? Blah, 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 blah. And lots of interviews with investors and interviews with CPAs who work with us and just various people in the industry that, do that. So there's a plethora of information. But Ben at lifeadvisorsolution.com is the easiest email. And then you got the website, and definitely can reach me there.
Ben Mohr, I want to say thank you so much for being a guest today and talking to us about something that most of us don't know about. That's an option, including the frozen head option.
Yes.
To my co-host Wayne Pratt, thank you, and you, the Knack for Business listeners. So, this whole thing, if you're looking for how to invest and doing something in it's an alternative means of parking your money and developing more funds, reach out to Ben. And it doesn't matter where you are. The policy's got to be in the U.S. And if you're in the U.S., there you go. It should be a no-brainer. Oh, bad pun again. I apologize.
Yes.
With that said, to my Knack for Business guests and listeners, thank you so much for joining us today.
Everything you heard today is for educational purposes only. It's not professional advice. Before you act on anything, talk to a certified expert in your area. Your accountant, your lawyer, someone who knows your situation. We share perspectives.